Welcome, everybody. Hopefully everybody can hear me. We had a little sound issue at the beginning. And I will tell you, this is our first time using the Google Hangouts presentation. So we may have a little bit of bumps and bruises along the way. Today's purpose is to go over the materials that we were unable to cover when I was there in Arizona with you. So we're going to go over the rest of the presentation. It's going to take about 40 to 45 minutes. Where I want to start today is going over the material that we covered and highlighting those areas that pertain to the questions that you'll have on your exam that we provided for you so that you get your continuing education requirements. So that's where we're going to start. I'm going to hit the areas of those slides as well. And I'll also share with you this. This is a new feature since we're doing this today for the first time here in our office. Usually I participate in a lot of conference calls. We do a lot of webinars. Now that we have this functionality at our office once a month, we're going to offer a free 15-minute webinar provided by one member of our staff. It'll cover a different topic every month. One of the topics we're going to cover in the near future is the new rules on salaried employees that are going into effect in 2017. In fact, they might be going into effect at a time in 2016. That'll be part of one of the webinars of our series. So we're looking forward to that. Anyway, let's get started on what we missed and where we stopped. So I'm going to share my screen now. So you should be looking at the presentation that we had. I'll go back to the very beginning of the presentation. This was the presentation as we started. Again, I want to highlight a couple of areas first. One of the first areas, I'm looking at slide 5. The first area is, what is a definition of a contract and what is not a contract? And I think it's important to know that a contract is not just a promise between two individuals to perform an act. So when you're looking at this slide and we're looking at the definition of a contract, it's not just a promise to perform an act. That's not a contract. So keep that in mind. Take a look at slide number 8. We talked about listing agreements. We talked about what they need and what they don't need. And bear in mind, a listing agreement is a contract between a listing agent and the seller. It does meet the definition of a contract. And it's very important. Why? Because it must spell out the listing price and the compensation to the broker. So be careful in your contracts when you're doing contracts for the sale of a piece of real estate or the sale of a business. Make sure there's a listing price in there and that your compensation is spelled out as clearly as you can. A lot of the issues that we see revolve around, well, Roman, what do I do if it's an earnout? What do I do if it's an installment contract? How am I going to collect my commission on those pieces? Spell that out in the listing agreement because that defines a contract. Let's take a look at number 10. We talked about the formal requirements of a deed in order to convey property. And it's important to know that a deed is necessary to convey property. Do we have to have a survey? No. Do we have to have an exam? No. Here's a good one. Does the deed have to be recorded? No. Recording of a deed puts the public on notice of the transfer. It doesn't make the transfer effective. The deed itself is what is necessary to convey real estate. I can sign a deed right now and give you a piece of property. That deed is effective. If you don't go and record that deed, there's some legalities involved with what if I give a deed to someone else in that same time frame? Who has the best title? Typically, it's the first person to record it at the courthouse, but it's not required to be recorded. So keep that in mind too. Looking at slide 11, and I just wanted you to know that, look, if a sale is perfected, a seller in a sale of real estate does not have a grace period to change his or her or its mind, unless it's in a contract. But in general, no. Once a sale of real estate has taken place, there are no lemon laws with regards to real estate. It is effective upon its sale. A seller does not have a certain period of time to change his or her mind once the sale has been completed. We talked about Arizona. You know what laws are effective in Arizona surrounding real estate. As you know, it is a community property state. There are a lot of intricacies because of that. Let's fast forward to slide 16. And we were just looking at loan defaults on slide 16, commitments for financing, things of that. Another part of slide 16 was the standard of care and the broker's duties and obligations under a contract. We defined agency and what it is. And keep in mind, it's the relationship that occurs when a broker represents a buyer or a seller in a real estate transaction. I think you guys are well aware of what an agent is defined as. Some of you are agents of your brokers. You are an agent also of the buyer or the seller when you are dealing with listing or selling a company or a piece of real estate. What are the standard of care and broker duties and obligations under a contract? Look at the slide. Loyalty, confidentiality, and disclosure. Those are your standards of care. Okay. Let's look at 19. Slide 19, we talked about dual agency. Dual agency, is it desirable? Is it desirable because it earns you what we call a double commission? No. Is it easier on all parties involved? Not necessarily. That's not the effect of dual agency. Yes, there's a purpose to dual agency. There's a reason for dual agency. As you can see here, they're allowed. However, just because it's a doubling of a commission in some respect does not mean that's the reason for it. Okay. Take a look at slide 22. We highlighted the Arizona Constitution, Article 26. Brokers can engage in limited practice of law by drafting the purchase contract. Okay. Now, as an attorney, and I don't know how other Arizona attorneys feel about it, I would prefer that brokers don't do this. That's my honest opinion. However, those that do, they are allowed to do that in Arizona and other states. I had a follow-up question from someone that called, left a message with us. We haven't gotten back personally to that person as far as I know, and said, Roman, I don't think it's the only state that allows it. And he's correct. That person is correct. It is not the only state in the union that allows brokers to do this. However, what we do know, it's the only state that we know of in the union where it's a constitutional law. It was done by constitution in the state of Arizona. Other states have statutes that govern it and allow it. As I told you before, I'm licensed in multiple states. Those other states do not allow it. They're not similar to Arizona. But Arizona has it as a part of its constitution. So it's very unique as far as Arizona goes. And know that it is Article 26 of the Arizona Constitution. That's what's important for your purpose. Talked about the deed a little bit. We talked about recording. I explained the difference. When should recording take place? Immediately. Absolutely immediately. I briefly said, look, what if I give a deed to you and then I give a deed to another person who has proper title? In some situations and in some states, it's all about who records first. Okay, so we're going to slide through now. Slide 26. We started in on this and we started talking about the letter of intents. And we got through a little bit on the LOIs. And then we continued on with those. And then we talked a little bit about asset purchase agreements, their purpose, why we use them. We kept going on APAs. We looked at the IRS Form 8594. We had it on the screen. Again, that's a form that you should pull up. And we stopped in this area. We stopped around the goodwill agreements. And that's where I want to start, is right here. So we start with goodwill agreements. And we're looking at, really, there's two types of goodwill agreements. And we're going to discuss these as we go. And personal goodwill, I'm going to give you the cases now. I mentioned them at the very end of the seminar. We're going to go over the cases that are important. Personal goodwill can be sold in some situations. It can be sold when the personal attributes of the seller help the business. And company goodwill can be sold when the goodwill relates to the company. So when you have a business that you're helping sell, if we're looking at the assets of the company and we're trying to structure the assets of the company for the best possible tax consequences, One of the things we're going to look at is whether or not we can allocate to the personal goodwill of the owners. What have the owners done? What is their relationship with their employees, their customers, their community, their involvement? Is the business value driven because of who they are and what they do in their community? Then they have personal goodwill. And there's a lot of definitions for it, but we'll stick to just the generic description of, look, we've got personal goodwill and we've got company goodwill. We talked a little bit about, look, when we allocate to these, why do we want to allocate to these? Because if we're selling assets of a company, let's say it's a fully depreciated C corporation, so it has the potential of double taxation when we allocate to the assets. And then any money that's distributed to the owners is ordinary income. If we can distribute money as personal goodwill, it avoids the corporation at the closing. Let's just use some basic numbers. Let's say the assets are worth $200,000. And I say, look, I think the personal goodwill of the owners is half the value of this company. I can allocate $100,000 to personal goodwill. I've avoided $100,000 going into the company completely. I have to have a separate contract. I have to have a separate closing. And I want that money to be deposited directly into the owner's accounts. That is capital gain to the owners. It is not ordinary income. There is no basis for it. So it's capital gain on the entire $100,000. But it is completely avoided the double taxation scenario under the C corporation. That's not the only reason to do it, is the avoidance of the double tax. It's also to get the capital gain treatment. Now, when we do the company goodwill, maybe we say, look, now there's $100,000 left of the assets. We're going to allocate $50,000 to inventory, accounts receivable, cash, whatever else we may be selling, and we're going to allocate to the company goodwill. We're going to allocate 50% to the company goodwill. Yes, in a C situation, that money is going to go into the company. And then if we distribute it to the owners, it's going to be distributed to the owners, and there will be double taxation on that company element. The key is that we've allocated to it. We've tried to describe it, and that we've tried to allocate to it. There are these elements, and we're going to get into these in just a minute when we look at the cases which are coming up, as far as, is there an employment agreement? Is there a consulting agreement? And is there any existing covenant not to compete? Right now, let's just leave it at that. Ask those questions. So whenever you get involved in a purchase and sale of a transaction where there's this potential of using company goodwill, you want to ask the question, is there a current existing employment agreement? Is there going to be an employment agreement? Is there a consulting agreement? Is there going to be one after the sale? And are there existing non-competes? Do the owners currently have them? And are they going to have them when the sale is complete? Okay, so let's take a look, and we're going to explain those three elements right now as to why we have to know those three elements and why we think they're important. The Martin ice cream case. Now, this is really where we stopped our lecture that afternoon in Arizona. We stopped right here. We said, look, we're going to stop at the case review. So let's start talking about the Martin ice cream case. This was a tax court case. This dealt with a distributor of Haagen-Dazs ice cream in the mid-1980s. They allocated, when they sold his distributorship, they allocated 46% of the purchase price to what was known as, quote, seller's rights, and what we now claim is personal goodwill. The IRS disagreed with this, saying you can't have all this personal goodwill. You can't tax this as a capital asset. And they argued that all of the goodwill was attributable to the company, not personally to the owner. And the IRS lost in the tax court, and the idea of personal goodwill was created. Will you find it in any statutes? You will now as it relates to potentially divorce and how a business is valued in a divorce. You will see references to personal goodwill. But that is where it started in the Martin Ice Cream case. That has now been defined better. The second case that came about was Norwalk, and this had to do with the personal relationships of accountants that they classified as personal goodwill. And what came out of this case that was important was a comment that if you have a current non-compete with your company, then personal goodwill does not exist. And that was what came out of Norwalk. Even though there was an existence of personal goodwill with the personal relationships of these two accountants that were selling their accounting practice, you cannot have a current non-compete with your company and allocate to personal goodwill. How would this come about? Look, I sold a company in Louisiana about 2 years ago, 2.5 years ago now. No problem at the sale of the business. We sold the personal goodwill of the owners and we sold the assets of the company. However, the new owner gave the old owner a stake in the business. So we sold the personal goodwill of the old owner, but now he owns part of the new business. The new owner made him sign a non-compete with the new business. If that business ever resells, we cannot allocate to the personal goodwill of that owner again because he has a current existing non-compete with his company. That's why you got to ask that question. Now, if you're dealing with a single owner of a company, most likely they're going to say, no, I don't have a non-compete with my own business. If there is more than one owner, there is a strong chance there might be a covenant not to compete in existence. And you'll have to know that. We'll have to find that out. You don't want to find that out after the fact and then have your allocation get struck by the IRS and get reallocated along with penalties and interest. It's very important. So Solomon was the next case. These are more recent cases. Solomon was a case. It was a mixed ore company. They had one agreement to sell the company for $1.5 million under Solomon. They allocated 1.4 million of that. So what is that? More than 90% of the sales price. They allocated to goodwill. They claimed it was a customer list and a covenant not to compete. They allocated only $100,000 to the equipment under Solomon. They argued that the customer list, the 1.4 million, was personal goodwill. And the tax court said, look, you made no reference to it whatsoever in your asset purchase agreement. All you said was customer list and covenant not to compete, 1.4 million. You did not mention at all personal goodwill. Therefore, you can't have it. So again, another reason why we want to make sure we've mentioned it, we've allocated to it. I like to have a separate agreement for personal goodwill, a separate closing statement, a separate check. That's why, because of Solomon, we have this separability factor. It's got to be separate. However, let's move on. Look at Kennedy. Kennedy was the next case. Kennedy, they had 3 agreements. They had a personal goodwill agreement. They're improving, right? They had a consulting agreement, and they had a purchase agreement for the assets. Their error was that the consulting agreement was for $0. And how many times do you guys have a transaction where you will not allocate to the consulting agreement? It's often. It's not as often as it used to be. But even 5 years ago, I would very, very commonly see a consulting agreement that was for $1,000 a year or no money at all. In the Kennedy case, the tax court said, look, the payments that you're making under this goodwill agreement, now remember, they had a goodwill, they had a consulting, and they had a purchase agreement. So the tax court said, look, that the money you've allocated to the goodwill agreement, that's for consulting. You can't tell us that the seller, he or she is putting in effort after the sale, and it's all based on the personal goodwill of the seller. No, that is consulting. That is ordinary income to the seller. So you're talking about usually at the minimum, a 13% tax hit on any money allocated to a consulting agreement, plus interest, plus penalties, plus the hit on the reallocation of any other assets. So it's very important to know the factor here is the employment agreement or consulting agreement has to be reasonable. You can't have a $0 employment agreement or consulting agreement in your transactions if you're also allocating to goodwill. I don't care if it's company or personal for that factor. So now we have separability and we have reasonable compensation under consulting or employment. The last case, we don't have it listed on this slide, is Howard. Probably one of the most important cases right now for personal goodwill. In Howard, the taxpayer had a covenant not to compete with the company which he worked for 3 years after the stock ownership, and the covenant not to compete was good for a 50-mile radius. The tax court came in and said, look, the covenant not to compete has blanketed any room for goodwill, and there was no employment agreement. He only had a covenant not to compete for 3 years after the sale. Now, how often do we see this? Extremely often. We close a transaction. Our seller has taken back a covenant not to compete for a period of years. We've allocated to goodwill. We haven't done an employment agreement or a consulting agreement. So you got to tie this concept together. The tax court wants us to have a consulting agreement or employment agreement that makes that seller available to the buyer during the non-compete period if we're allocating to personal goodwill. They've got to have access to the seller's personal goodwill during the non-compete period. Now, the biggest question I get is, well, Roman, he's signing a 5-year non-compete. He does not want to be on the hook to work for them for 5 years. He'll work for 2.5 years. All I can tell you is I think that the IRS, if you did something like that, you have a 5-year non-compete, you have a 2.5 year, just to reference where we're at, we should be on slide 30. We're still on slide 38. I have not advanced any slides. We're just talking about these cases, and we are still on slide 38. The tax court, I think they would say, if you had a 2.5-year employment agreement and you had a 5-year non-compete after the sale, I think the tax court's going to say, look, you can only take half of the allocation you allocated to the personal goodwill. The other half is going to go towards consulting or other assets. And you're going to have an ordinary income tax and penalties and interest. So be careful. There's really no fine rule now on how to do it. I do try to match them up. My goal is if it's 3 years of a non-compete, then I want 3 years of an employment or a consulting agreement. Okay, we're on slide 39. So you should be seeing slide 39. That wraps up goodwill, and I wanted to make sure you guys knew about it. Now, very often on goodwill, very often we have updates, and I do think we will produce probably 2 to 3 a year on the court cases for personal goodwill. So keep that in mind as we go forward on personal goodwill. So let's take a look at the security agreement and the notes. What are they? How they are entered. And let's take a look at what are they. They allow a seller to claim property in the event of a default. They're written. They must be in writing. So I recommend adding these to all your contracts, all your purchase agreements where there may be a seller carryback note. And I see this a lot now. Whether you know it or not, there's a lot of security agreements in, first of all, your listing agreements. We'll talk about that in a minute, but also in your purchase agreements. If there's a note involved, if there's any type of seller carryback note, I would highly recommend you put security agreement language in the purchase agreement from the get-go. You can put enough in there that it suffices as a security agreement. Although we have a standalone agreement, we do like to have done at closing. We present it as a closing document, and we like to have that. an interesting comment I always make for brokers is you can put these in your listing agreement and put a lien on assets in your listing agreement under the terms of a security agreement. And then if you have a commission problem on the back end, at least you have this feature to fall back on and fight if you need to collect your commission. About once a year, I get a call from a broker around the country that did not get paid a commission as they were supposed to. Had they had a security agreement in their listing agreement, they may be able to seek the assets as compensation, or at least have that as a threatening maneuver against their client. I know it's not something we love to talk about. It's just a feature. And again, how are they entered? They can be as simple as signing a receipt. We do this all the time. You go to Best Buy and buy a TV on credit. Say, I want to pay 90 days, same as cash. You sign the receipt. You have actually signed a security agreement. If you don't make those payments, not only can they sue you on the contract value, they can also come and repossess the TV. That is a security agreement. Couple points to make here as well. And I've seen ours be held up in court. We had one of ours challenged many, many years ago. We took the security of the stock of a company that we helped sell. As for the seller, there was a note. We took the stock of the new company, the old company. We took the assets. We put everything under the security agreement. The court upheld that and said that was valid. I do get a lot of attorneys sometimes that say, well, you can't put a lien on the stock of a company. Yes, you can. Under the terms of a security agreement, you absolutely can. In fact, that court case was up in Wisconsin. That case went to arbitration because we had an arbitration clause in the security agreement. The arbitrator decided in favor of the seller, allowed them to take back their stock under the terms of the security agreement, and the court upheld the arbitrator's decision. So I'm very, very pleased and very confident to know that our security agreements, they held weight, and they held weight in one of the most important scenarios they ever needed to. Another example, though, is what if you don't have one? What's the court process involved? There's so many different processes. One of them is called a distress warrant. This is where somebody may owe another company money. One thing you can do in a scenario where you are able to invoke a distress warrant, and it will depend on the laws in the state, the county where you're in, or where the businesses are operating, you can go in and take inventory in lieu of payment. Your clients can do things like this. They can take inventory in lieu of payment if they don't make one of the seller's notes. If the seller does it properly, he can go in and seize the inventory. He files what's called a distress warrant in the courthouse, listing the property that he has seized. He is then allowed to auction that property to defer some of his loss that he has taken. We did this in the past. I've done this successfully. These are enforced. It's even enforced in bankruptcy down the road if there is a deficiency judgment. In other words, your client took the property to take the note payment that the buyer did not make. They sold the property, but they still weren't made whole. They sue them on the differential. They get the deficiency judgment. The deficiency judgment can be, then now they are a secured creditor. Now they have a judgment. Now they are just like they did a security agreement, and they are a secured creditor. And they can go into the courthouse and use that judgment in a bankruptcy court against the buyer if they decide to file bankruptcy. In fact, I just had that. After 10 years, I had a case where we had a distress warrant that went all the way to judgment, that went all the way to deficiency judgment. We got it into the bankruptcy court. The bankruptcy court did not know what to do with it. The bankruptcy attorneys did not know what to do with it. It was valid. It was upheld. We threatened foreclosure against the client, and we ended up getting our client a healthy 5-figure check in relationship to that. So if your client does not have a security agreement and a note was breached, just be aware there are still possibilities to be able to recover those funds. That's what I wanted to point out there. Now, we talked about the security agreement. It's got to be in writing. It's got to define what you're securing. I told you in the one that we did for Wisconsin, we said, look, we're taking the stock of the company. We're taking the inventory. We're taking the accounts receivable. We're taking the deposit accounts, what we call the chattel paper. We've got it in writing and we've got it done. However, just like a contract, That's not what's recorded. On slide 40, which is what I'm on, the financing statement is what is recorded. And it explains the duration. They're usually good for 5 years. It perfects the interest if it's filed. So just like a deed being recorded, if a financing statement is filed, the interest is now perfected and your client is now a secured creditor. It's good for 5 years. Typically, the filing office is the Secretary of State. Typically, that gives you priority. So now you filed it. It's good for 5 years. It's filed in the Secretary of State's office, and now you have priority. Don't forget, when the client has paid it off, when the buyer has paid off the seller, a termination statement needs to be filed. That's the third point there on slide number 40. You've got to remind your seller client, look, if you were paid for the note in full, we've got to file a termination statement. Very easy, very simple to file. And if they don't pay them in full and 5 years has expired or is going to expire, a continuation statement must be filed. These must be filed only within 6 months of the expiration date. If they're filed outside of that 6-month window, they are no good. It's only within 6 months. That's the beauty of a financing statement. I've advanced it to slide 41. We're still on security agreement, notes, financing statements. And remember, I said security agreements, they themselves are not recorded anywhere. It's like the terms of the loan. The terms of the loan are not recorded. It's the mortgage that's recorded. It's the deed of trust that's recorded. And in this case, it's the financing statement that's recorded. Okay, let's talk briefly. We'll go on about another 5 or 10 minutes is all I've got left. But let's talk briefly about buy-sell agreements. I always recommend these when you've got more than one partner in the business, unless there's a husband and wife situation. But even if it's a father and son, or daughter and mother, daughter and dad, whatever, 2 friends, 2 nephews, or beyond that, highly recommend that you have a buy-sell agreement. It gives protocols for the shareholders. It allows for at least a methodology to transfer the company should there be a dispute, should somebody want out, and it allows you to value the company. What we do in our buy-sell, we attach our valuation methodology to the buy-sell agreement. At least we've established that methodology. I had a case once with a heating and air conditioning company that had 3 partners. They started up. I started them up. I incorporated them. I did their corporate record book, their minutes, their bylaws, their operating agreements, their employment agreements between them and their company. And then we did a buy-sell, and it was very basic to begin with. But the key feature of the buy-sell, and it said, look, if one of us decides to sell, we got to offer it to the company. The company can buy it. If the company doesn't want to buy our shares, then the individual shareholders can buy our shares. If they don't want to buy our shares, then I can sell it on the open market to anybody that I want. But the key was that we attached a methodology. Now, there were no numbers. We just started them. But we told them, look, we're going to put a cash flow method on there. We're going to put an earnings method on there. We're going to use an asset method, and we're going to use a goodwill method and maybe comparables. Excuse me. So we outlined how we were going to calculate the value of the company. Within about 4 years of forming that company, one of the partners got disgruntled and decided to get out. While we didn't stick to the actual dollar that the valuation was, and we could have forced the issue and said, here's the methodology, here's the value, this is what we're sticking to. It at least got them all to the table, and we settled it within 1 day of showing them, here's the valuation. What do you guys want to do? Do you want to fight this out? Does the one person leaving think it's valued improperly between the other 2 shareholders? Or do you want to make an agreement? And it did. You know what? It worked. So that's our feature on buy-sell. Make sure that they have one, or at least discuss it with them. It's a heck of a value-added service that you as brokers can provide to them, and it will keep them out of court, and it will make you look good down the road. It really will. They have triggering events in them. Our buy-sell agreements do. These are just 3 that we use. There can be many more. Death can be one. If someone dies, then the company is obligated to buy out that partner. If divorce, why do we want it if there's a divorce? We typically make this a triggering event. In fact, I've not really ever seen it be pulled out of one of ours. Because if the court says, look, spouse, you get 50% of the interest. The other partners don't want to be partners with the spouse that they don't really interact with. So it triggers all of that interest to be bought by the company if the company can afford to buy it. Medical can be a reason. Another reason that needs to be added there that you need to always consider is employment. If you've got 4 shareholders and one of them decides they don't want to work for the company anymore, that should trigger the buy-sell. I've practiced now, almost 14 years. I've only seen one time where we removed that employment language because it was a son with his other siblings, and they didn't want to say to him, look, just because you don't work much, and if you decide not to work, we don't want you to have to be bought out. So they removed that. So if he ever stops working for the company, it doesn't trigger him to have to buy his share, trigger the company to have to buy his shares. Now, a lot of you are probably sitting there saying, Roman, it's always a problem. How do we buy the shares? Do we fund these with life insurance? The company maybe can't afford life insurance. And what if it's not a death? How does the company fund the buyout? Ours are all structured. We start with this structure. We say, look, we're going to look at the average salary this person earned for the last 3 years. We're going to give them a down payment on the value of their company. So if they earned $100,000 a year for the last 3 years, that's their average per year, and their value is worth $1 million, we're going to give them $100,000 a year in principal plus interest until we've reached $1 million of principal. And we're going to amortize that out however long it needs. Is it 10 years? Is it 15 years? And we're going to give them a down payment. Typically, we say, look, we're going to start with a 20% down payment. If the company doesn't think they can afford that, then we can put a smaller down payment in the buy-sell agreement, maybe 5%. The company's going to pay 5%. In fact, we did one just recently. It's sitting on my desk here in Illinois. It says, look, it's going to be a 5% down payment and interest only so long as the current debt is still on the books, not any new debt, but so long as the current debt remains on the books. Once the current debt is paid off on the books of the company, then they have to start making principal and interest payments to the shareholder or the shareholder's estate. So that can be tweaked tremendously, but don't ever let anybody say to you, well, we can't afford to buy somebody out. Well, that's not really true. You can structure the buyout so that it's affordable. And again, you can look at the triggering events. We talked about, I'm on slide 44. Again, still looking at buy-sell agreements. Violation, when we talk about violation, we're looking at did someone try to transfer the share and they were unauthorized to do that because of the buy-sell. If they did it properly, we put a legend on the back of the stock certificate that says this certificate is subject to a buy-sell agreement. So any buyer doing due diligence of that seller's shares will see that legend on the back of the stock certificate where they're supposed to sign it. And they're going to realize you can't buy your shares. You're subject to this buy-sell agreement. Also, do they fund them with insurance? Do we need to fund them with insurance? We did one recently where it said, look, if we can't get life insurance on this particular partner for one reason or another, then his value is capped at $1 million paid out over the average salary he earned over the last 3 years, plus an interest rate equal to Wall Street prime. That's what we did there. So if someone's not insurable, cap the value in the buy-sell. That's to the company's benefit, to the shareholder's detriment. And that logic tends to work. Okay, guys, we covered it. We finished it up. This webinar is going to be available to all of you at any time. I think the Google Hangout should be available to you. And if not, we'll do this one. I do this one quite often, and this will be part of our ongoing series. But look, we looked at a lot of things. I know we were a little bit skewed when we first started, but look, we looked at the legal issues in buying and selling a business, in buying and selling real estate. Don't skimp on the due diligence. Document everything in full, the letter of intent, the purchase agreements. the installment contracts, the real estate contracts, the listing agreements, the security agreements, the buy-sell agreements. You know, hire good professionals, work with their local professionals. It's important to have a CPA that's knowledgeable, especially when you're dealing with the goodwill issues. As you saw the cases we went over, there's new cases almost every month. There's a new personal goodwill case. So be on the lookout for that. Make sure you're working with someone that understands those concepts. Get documents from a reliable source. Review them with your counsel. You in Arizona, very fortunate that you have that ability to do some drafting. Be cautious, be careful. Explain the documents. Always keep your communications open. All of those things. On slide 46, we covered a lot of questions. If you have any questions after today, you're welcome to email me. It's rbasey@taxplanning.com. If it's legal or tax related, I will probably forward it to my research assistant, Marcus Renwick, and either he or I will respond to you. If you'd ever like to talk with us directly, you're welcome to call our office, 618-997-3436. One of my assistants will always set you up with a phone call where you can talk with us. If your clients want to have a phone call with us, I always offer a free consultation on the phone. I'd like to see their financials and tax returns before that conversation. However, if we don't get them, we'll still have the phone call with them. We went over what the material is on your exam. If there's any questions or problems with that, please give us a call. And of course, there is our contact information. We've already put all of you on our tax tip list. Those of you that are Arizona brokers that attended the presentation in Arizona. Anybody that did not, please email me your email and we will put you on our tax tip list. It's a once a month free advisory with a tax law or court case that came out or an end of year planning tip. If you want it via US mail, send us your address. I know a lot of emails go to junk, and that's fine. And there is our location in Illinois. Thank you, everyone, for attending in February. I had a wonderful time, even though we were delayed a little bit. And thank you for listening today. Hope you found it informative, and I hope that we can help you in the future. Thank you.